until the advent of COVID-19, the loan deposit ratio of 65% requirements in the commercial lending space had forced Nigerian banks to lend more to the public. The regulation came on the heels of the emergence of online credit agencies that engage in aggressive retail lending to the public in a competitive manner with the commercial banks. As a result of the outbreak of COVID-19, however, loan default across the retail and corporate segments of the divide have surged, a development that has pressured ratings agencies like Augusto & Co. to review upward its earlier forecast of 9.4% non-performing loans ratio to 13% in 2020. Now, joining me now to paint a clearer picture of the status of non-performing loans is the Chief Executive Officer of Credit Registry, Jamila Sharif Ayedu. Thank you very much, Jamila, for joining us.
Thank you very much.
So how much of disruption has COVID-19 brought to the credit space lately, and what are credit bureaus like you learning about this pandemic?
Yes, so first of all, thank you so much for having me this morning. I believe the one thing, there's like over 6 million cases that have been reported for COVID-19 around the world globally, and we see about 400,000 deaths. And so Nigeria has been impacted as well. There's been about 9,000 cases reported to date in Nigeria, with about, say, I think there's about maybe like 300 or so that have passed away as a result of that. So this pandemic has seen the country as well as globally, it's impacted us medically, but it's also impacted us economically as well. So we've been able to see, like just over the last period, where there was an increase in the number of loans being given in the first quarter of 2020 compared to 2019. Between the months of March and April, we've seen a drastic reduction. We saw an increase between that first quarter from last year of about, say, 72% loan assessments. And just between those 2 months, between March and April, that reduction has been about 50% or more. And this is, partly because there was a lockdown in the government. And so we saw that people were actually leaving their jobs, the banks were closing, a lot like that. But we also realized that in general, due to that loss of jobs, people have just not been able to afford to get those loans.
Yeah, we saw until COVID-19, the 65% LDR regulation for banks, increased. What has the pandemic changed in default rates?
Right. Interestingly enough, the Director of Financial Policy and Regulations has actually re-emphasized the need for lenders to maintain that 65% LDR. Now,
but don't you think that would actually impact on their balance sheet eventually?
Yes, I think we have to be very careful with this, but I know that the central bank has also put in measures and supported with new policies to be able to help lenders not only continue to open their banks up for access to credit, but they've also encouraged them to do things such as restructuring of their loans, to reduce the interest rates. They've even introduced, if you will, intervention funds to be able to support that, so that the banks can be able to extend, if you will, access to credit to more people. That is important, though, if you think about it. I mean, the economy can only be as strong as people being able to continue to be employed, and companies can only continue to be open to support those employees if they have access to credit during a time like this.
Now, talking about restructuring the loan, of course, we had Sterling Bank, for example, had to have its loan restructuring fees for new and existing loans. How do you think such development will help to moderate the non-performing loans?
Right. In fact, Sterling Bank, and there's a few other banks, UCGTB, Standard Chartered, Stanbic, Zenith Bank, a lot of them have put in these moratoriums, or should I say payment freezes or payment holidays, to support those borrowers that are already on their loan books. And I think that's incredibly important because, this is not something where you have an unwillingness to pay. They just have an inability to pay potentially at this time. And so that's going to be important so that non-performing loans are not being reported to the Bureau as non-performance, because that's going to impact someone's future credit capability. So we are strongly encouraging lenders to allow for that so they don't have to report their customers as non-performing.
So across the online retail lending ecosystem, how has the rate of loan default affected those fintech?
Yes, so I tell you that fintechs, they're not regulated by the central bank. I actually believe that that's probably not so bad because they're very innovative. They are willing to take some of those risks that a regulated institution is not necessarily able to take. However, it does leave them very susceptible and vulnerable in that they are not all reporting to a credit bureau. The banks have our institution as a huge way to help them be able to curve, if you will, to curve defaults. And we're saying that the fintechs, you have that same capability. We empower you. We actually encourage them to report their loans, even if they're not, of course, deposit giving or anything like that. They need to report their loans, good and bad, to protect that whole ecosystem that they're now a part of. Because customers, they're free agents and they can go anywhere. And
Absolutely.
if you are not reporting, that means that the thousands of users that are utilizing the bureau are none the wiser about the credit that's being given.
Now, for individuals and perhaps businesses now who had their accounts credited before March 2020 for debt settlement, for example, and at that period, check clearance, was suspended by the CBN until April. When another settlement was actually due. How did credit bureau like yours manage this situation?
Right. It's actually a very serious matter. So because I know that consumers, we do have the ability to be able to give checks, right, in order to pay our obligations. And during that time, as the Bureau, we do collect that information from lenders. If a check has not been honored or it's a dud check, that is being reported. So I would say any consumer that has been impacted by that, call your bank. Call your bank, make sure it is addressed, make sure that that doesn't negatively impact you because that is being reported to the Bureau. And so that will help them. We've also introduced an easy way for lenders as well as any service provider or any, say, retailer to be able to know if someone has written a dud check. So that way they can quickly be able to determine if they will accept any more checks from an individual. And so that also opens it up on the other side, that individuals are able to use their checks because now there's a way to determine that I'm good with credit. You can trust me. So give me this access, especially at a time like this when I really, really need it. And so we should be able to encourage
Now,
that.
what about individuals, employees who, of course, had their jobs and perhaps were paying their loans and now their jobs were affected because of the job cuts brought about by the COVID-19 pandemic? How are such cases being handled by credit bureaus?
So as a bureau, we don't create information or modify information that's being reported by a lender. So I encourage every employee that has found themselves in a position whereby they have lost their job to immediately contact their lender. The lender is in the business of making and generating money from giving loans. So it is nothing better to them than to have a customer call them in advance to tell them I'm having problems, because then they're at a point of being able to help. Because once it's reported to the Bureau, it is reported as non-performing if you haven't addressed that with your lender. So definitely reach out. Don't run away. It's not going to stop. It's not going to be written off. The banks are not in the business of writing off those loans, but they do expect that payment, but they will work with you as a borrower to make sure that you are not negatively impacted by it.
Well, in the midst of this COVID-19 pandemic, the central bank, of course, announced several stimulus measures. How do these stimulus measures impact your activities? The interest rate on major government facilities have been from 9% to 5%, and we have moratorium on these facilities.
Yes, yes. I think that that's a great initiative. The CBN's Intervention Fund, which is actually being managed by Nassau MFB, we're trying to work with them as well to have that information reported to our bureaus. But this is a great way for the economy to continue to flow. So being able to have access for small businesses, and it's even open to individuals who have been negatively impacted somehow financially by this, pandemic. And so getting access to those funds, applying for those funds today, whether you're a school, whether you are a small business, or you are a fintech, or someone you really need access to be able to have, to grow your business and continue to sustain your business during this time, that is a great initiative. And it's being reported to the bureaus. So that's a way you can actually build your credit during this time as well.
Right. Okay, now there are this issue of collateral being required, even for this emergency funding. Just wondering why collateral will be necessary, at this time when we're trying to prop up businesses who are perhaps affected by this COVID-19.
Right. Now, there is introduction of the collateral registry, which allows for you to use even movable assets as collateral. And so this, again, once just protects the lenders, but also now makes it so much easier for a borrower to use what they have. People have this idea that collateral means you have to have a house or something that's more substantial, where with the collateral registry, you're able to have much, what you have available, whether it's your motorbike, whether it's, access to some asset that you have in your home, jewelry, things like that. And that's incredibly important because it opens up lending to more people. And that's what's needed in the market now.
All right, now looking at the first quarter GDP number, now financial and insurance were the second main drivers of the non-oil sector. Now, do you foresee any danger for the financial institutions, particularly the banks in the areas of non-performing loans? I mean, we're seeing fantastic results there, but some people are still pessimistic about what they're seeing right now.
Yeah, I think that lenders, they have to be careful, right? There's three things that I encourage for a lender to do during this particular time. One big one is to communicate. Know your customer, yes, that's one thing, but communicate to them. Let them know that there are ways whereby they will support them to get through this pandemic. It also helps that customer know that, again, they can't just run away. It's not just going to stop. This is something that is an obligation that they must do. The second thing is have compassion, right? We're in a particular, no one brought this on to themselves. So have compassion, create new ways for that customer to be able to get to the other side.
But then they have to also consider survival strategy.
Absolutely. The last one I say is creativity. In order to survive, it can't be business as normal. We have to have a new normal. The way my grandmother did banking is different than the way I'm doing banking, is also very different than the way even my children are doing banking. So being creative, yes, the restructuring is fine, but one thing I put out there is say, I think banks should actually consider doing some form of loan consolidation. You have consumers who are having loans in multiple places for different reasons. Either their salary is in this one, so they have to take their loan from here, but they've taken maybe a fintech loan, and now they're trying to manage many loans at once at different interest rates. If they're a great customer of yours, help them consolidate that, especially at this time. That way they'll have one payment that they can be able to get at, hopefully at a better interest rate, and then be able to maintain and be able to pay off that loan much more quickly and easily.
Right. Now, post-COVID-19, what is likely to change about the way credit bureaus handle debt and repayment records?
Yeah, for us, I think there's a few areas that we're going to change in. I mean, I think one is just being more vocal and bringing more awareness that a credit bureau is meant for more than just the banks. We're actually open for business for many areas or sectors. We work with telcos, utilities, small businesses, real estate, and so we say that if you are in the business of giving access to credit or services, you should be reporting that to the bureau. The second one is that ensuring that our clients are taking advantage of technology. We have APIs that allow for them to do more digitally, have their customers be able to reach them literally online. And then the last one is scoring. We believe that credit scoring is the area that's going to help lenders to be able to grow their portfolios, thus minimize the risk without just having a few people with bad loans. If you have more customers with good loans, it's going to be able to balance out those who are unable to. And so they're going to need scoring, credit scoring, to be able to do that. So those are the areas we're going to do. So, yeah.
All right. Thank you very much, Jamila, for sharing your thoughts.
Oh, it's my pleasure. Thank you so much for having me.
Jamila Sharif Ayedu is the Chief Executive Officer of Credit registry. Well,